Hello, everybody, and welcome back. Today, my guest is Robert Horrocks. Robert is the Chief Investment Officer at Matthews Asia. Welcome, Robert.
Thank you. It's good to be here.
Robert, today we want to discuss recent developments in China and the Chinese stock market. And especially Chinese internet stocks like Alibaba and Tencent have recently been hit hard by the government measures. So are we seeing a paradigm shift in Chinese state capitalism?
Yeah, I think the short answer to the question is yes. Although whether the paradigm shift that phrase makes it sound a little bit more dramatic than it actually is. I think what you're seeing is an evolution of the way that China governs and manages its economy. Since they opened up to the world in the late 70s, early 80s, you'd have this frenzied private capitalist expansion across the country, people making money, pulling themselves up into a middle-class lifestyle. And now the government's responding to that people have desires beyond just making money. They want to be able to save for their future. They need better capital markets to do that. They want a clean environment. They want the government to take care of some of the social aspects that come along with a modern life. And so what you're seeing the Chinese government do is slowly metamorphosize into the sort of government that we're actually quite familiar with in the West, that they take seriously issues of equality of incomes. They take seriously issues of access to healthcare, of the quality of the education that the young people can get. And so this is what the regulation is designed to do, is to make sure that companies, yes, are profitable and they can make money, but they're also not doing that by exploiting what the private or the ordinary citizen of China wants to see in their environment and their society.
So the hedge fund pioneer Ray Dalio recently said he believes the market is misinterpreting these measures by the Chinese government. Is he right?
Yeah, I think he's probably got a point. I mean, I think the biggest example of this was probably in the after-school tutoring, where what the Chinese Communist Party was doing was saying, well, we want to have a more equitable access to good education, not just for the rich. And we also want to be careful about the kinds of education that children are getting, that it's a little bit more broad than the rote learning of the past. And so they put through this regulation to sort of try and deal with that. Now, it hit some companies pretty hard, and it hit some portfolios pretty hard because of that. But these are small parts of the economy, small parts that have a big social effect. And I think out of this, there came this concern, this worry that China was turning against private enterprise. And I think that was an overreaction. And yes, that was quite a severe misinterpretation of what the Chinese were trying to do.
So you mentioned the for-profit education industry, but we have also seen companies like the ride-hailing company Didi hit hard by the recent measures. So will we see more of these events happening in China, and do investors have to prepare for more volatile Chinese stock markets?
Yeah, you'll see more events like this, and I think investors who want to access China's growth always have to be prepared for more volatility than they would perhaps see in their home markets. It comes along with a more dynamic economic environment and a more dynamic market. That's true. But I think that the regulatory efforts by the Chinese government, it's fairly clear where they will be focused. It's on the ownership of data, data privacy issues, access to that data. They're looking at education, access to education broadly across the population, access to healthcare as well. And we've seen regulatory efforts in all of these over the past few years. I think they'll be focused on speculation in real assets. That is the real estate market. They don't want to see trading of real assets. They want to see people living in houses. But there are also things that the Chinese are doing that will be positive for profitability. They want to see better quality of companies. They do believe in private enterprise. They know that savings rates are coming down as it becomes a more consumer-oriented economy. Therefore, returns on capital have to go up. So governance changes, a more activist stock exchange in China means that companies have to be more aware of how they're using capital compared to the exchanges in Western economies. So it's not all about attacking that profitability. It's actually about embracing private enterprise so that it provides the goods and services that the modern Chinese citizen wants.
So common prosperity has emerged as a topic in the political discussion in China during the last weeks. So what exactly is meant by this slogan, and what implications does it have for the financial markets?
Yeah, common prosperity, I think, is another way of saying middle class in many ways. I mean, when I was born back in '68, the majority of China would have been considered poor and very poor. If you look at China today, it's only a very small percentage of the population that lives below the global poverty line. So what you've seen is a country that's achieved a lot in terms of raising living standards. And now China wants to attack inequalities within its own society. And you've seen it do that over the last few years, for example, through the minimum wage. So the labor share of income in China has been pushed back up to historically average levels, where it's been allowed to languish in many Western economies. And as I mentioned, you're starting to see the trappings of a modern lifestyle: unemployment insurance, pension systems, insurance for property and casualty, and life insurance, a modern healthcare society with new innovative therapies that are being created within China. And the question is, does that benefit a few people, or does it benefit people more broadly? So you're going to see, as a company, because in the end we're all investors, as a company, you're going to see price controls, you're going to see some headwinds there, but that will hopefully be offset by greater volumes. And so that's how you have to think about common prosperity. It's embracing profitability, it's embracing private enterprise, but trying to spread the effects as widely as possible across the population.
So after the last month, do investors need to reassess regulatory risks associated with China investments?
Yes, I think they do, but they have to do it in two ways. One is to understand what the regulatory goals of the Chinese Communist Party are. And two, they have to understand their own misinterpretation, as Mr. Dalio put it, of what's been happening in the market. So I think they have to reassess their own reaction first, and then think about what the Chinese Communist Party is doing. Now, a client of ours mentioned that the real difference is the Chinese are putting in practice what we would sometimes call ESG type principles. So they care about governance in the companies, they care about the environment, and they care about the social impact. They're just putting it into action, whereas a lot of Western governments are dragging their feet. Or there are checks and balances in the system, and they're still arguing these things through. I think that's not a bad framework to use when looking at Chinese investing. And I think it will help you identify which companies have the highest risks associated with them, or which companies have the greatest opportunities. The other last point I would say on sort of how people should reassess is there are a lot of fine growth companies in China, and there have been some fine growth companies with very, very strong, almost monopolistic market positions. What we have learned is that monopolies will be allowed to exist, but not to drive or generate monopolistic profits. So just be wary on the valuations that you're paying. Even if a company has an extremely strong market position, given its exposure to some of the regulatory risks, you might have to price it not as a monopoly, but as a business in a competitive industry. But these are all things that can be taken into account. The growth in China remains. And I think so long as you have this sort of guiding light for your investments, it's still an exciting place to find good company.
So Chinese stocks listed in the US have lost around about 50% in value since February. So are these the effects of the decoupling of Western and Eastern financial markets?
Yeah, it's an interesting one. I've come across the phrase decoupling many times in my career, and it almost turns out to be the case. Markets and economies can decouple for a while, but tend not to over the long run. But I think there is something to what you're suggesting here. There's certainly a short-term decoupling that is driven by different views within China and outside of China on what the government is doing. We've talked about those a little bit. It's definitely been exacerbated by the tensions between, in particular, the US and China, and concerns over what the US side might do as well. And those are shorter term, although probably more acute in the short term, although I expect tensions between the US and China to continue. I do think there are some structural issues as well. We're starting to see the emergence of China's own technology standards, for example. We're seeing the emergence of the Chinese consumer. So trade links are perhaps not as integrated as they were because of that. China becoming a more closed economy, very competitive still, but just has a much bigger domestic market. And I think you're starting to see the independence of the monetary system a little bit as they try and create global demand for Chinese treasuries in the same way as there's global demand for US treasuries. So I think my answer is, yeah, a little bit. It's mostly short-term effects, but there is a sense in which China is beginning to stand on its own 2 feet a little bit more. And if we want to call that decoupling, then it's coupling.
So what do recent developments mean for your portfolio strategies? Where do you have made adjustments? And of course, where do you currently see investment opportunities in China?
I think it hasn't made a huge change to what we do. We've always been focused on the domestic demand side. Certainly as a company over the last few years, we've been strengthening our research capabilities, both on domestic innovation and also on the domestic healthcare sector. We've been strengthening our resources to look at issues around governance and issues around regulation. And certainly those are increasingly important now compared to where they were 10 or even maybe only 5 years ago. So that has changed. And I would say will continue to evolve over the years. That's a never-ending process. In terms of short-term changes in the portfolios, I do think that some of the businesses that have been hit hardest recently, some of them, not all, are starting to look attractive. And certainly I've noticed that, people looking at maybe increasing some of their weightings in one or two of the online names as they come down to valuations that we haven't seen in a while, and valuations that have normally been at the lower end of these stock long-term ranges.
So this was Robert Horrocks from Matthews Asia. Thank you very much, Robert, for being with us today and sharing your insights with us.
Thank you. Always happy to join you.